Hello, everyone. Thank you for being here today. My name is Hao Liu. I'm a reservist at the 19 Subs, as well as a Colorado real estate agent as my civilian job. I'm very delighted to have this opportunity to speak with you about this VA home loan and the home buying topic. Over the next 55 minutes, we will dive into this briefing. Whether you are already familiar with this subject or exploring it for the first time, I hope to provide you with valuable insights, practical takeaways, and a fresh perspective. So, without further ado, let's dive right in. So, today's briefing will be unclassified. What we will be talking about today will be divided into two big categories: VA home loan and home buying process. Within the VA home loan, we will talk about what is VA loan and who is qualified. And we will discuss some financial background knowledge about how finance could affect us in both good way, for example, to become a millionaire, or the bad way, how we suffer the interest payment. Other than that, we'll talk about why we want to use the VA loan, under what circumstance we use the VA loan, why we want to become a homeowner. The last 5W is when. Do we want to buy or do we want to rent? When should we consider buying? So second category will be the home buying process. We'll be talking about the COE, Certificate of Eligibility, which is the proof of that we are eligible for the VA loan. Then we'll talk about the lender, where we get the money from, the realtor, a real estate agent, the transaction professional who handle everything for you, and also the closing, what we need to be concerned at the end. All right, to introduce a little bit about myself, I'm currently a reservist with the 19 Subs. My civilian job is a real estate agent at Colorado. That's why I have some experience and knowledge on this topic, the home loan and the home buying process. So I am a Chinese, as you can tell from my accent. Uh, I was raised and born in China. I came to the US on a student visa when I was 17. Went to University of Denver, studied finance when I was graduating in 2015. So I really love the United States, right? So fortunately, there's a program called a MAVNI, which is the Military Access Vital to National Interest. So I got my citizenship through that MAVNI. Basically, I enlisted into the U.S. Army and I got citizenship through that. And I was staying like 5 and 6 years at Fort Wainwright, Alaska, at Fairbanks, which is the center of Alaska. After that, I transitioned to Air Force Reserve, currently with the 19 Subs, working as GPS VSO. So my goal today is to help our service member to learn about real estate, to know more about a VA loan benefit. Also, because of my background, study finance, I want to share with you some knowledge I learned from college about how financial compounding, time value of money, could affect us in a both good way and a bad way. And I apologize that I cannot be here today physically present to give you this presentation. So if you have any question, you're welcome to contact me through the cell phone or to send me an email. Disclaimer, as I mentioned earlier, I am a real estate agent, but I'm not a CPA accountant. I'm not a financial advisor either. I'm not a lender. So all this info are coming from my own experience and my research, as well as some coworker colleagues' input. Therefore, this briefing is for knowledge sharing only. I'm not trying to sell you anything, right? This is just for knowledge sharing. And by the way, I really like memes, so throughout this entire briefing, you might see a lot of memes within that. Hope you won't get a emotional damage from that. So we finished the introduction. Let's jump into the VA loan. What is VA loan? Who is qualified? So what is VA loan? VA loan is a way to get the money to buy your house. However, it's not for everyone. It's only for service member, and you have to earn it after 90 days of consecutively active service. That is to see your basic military training time doesn't count, your tech school doesn't count. It has to be when you're actually serving in the service. And you qualify after 90 days. So it's a loan that is provided by private lender. So lender, some people call them loaners, which is like who gave you the loan. It could be anyone. It could be banks, like Chase banks, Wells Fargo's banks, or mortgage companies, for example, like a Veteran United, right? They are not only one doing the VA loan, by the way. And also some credit union, like a ENT credit union, they are all considered as lenders because they are the one who give you the money to buy a house. So why VA loan is can give you a lower rate? Because so the Veteran Affairs VA, they guarantee 25% of your entire loan. So even if you default, a default means if you cannot pay off your mortgage, you cannot pay the mortgage back, the lender still can get some money back. So from the lender perspective, you're less risky. Therefore, they are willing to offer you a lower rate. So, but some limitation of the VA loan, for example, it cannot be used for commercial or land purpose, only for primary residency. However, I know there's a term called house hacking. So it's applied for like a multiplex, for example, duplex, triplex, or quadplex. Basically, it's like a one big property, but it has a several unit in it. So duplex has a two, so you can live in one of them and rent out the other unit. They're completely separate, so you guys have a privacy. So I know a friend who bought a like quadplex, like 4 units before. He lived in one of them. I rent out the other 3 rooms, and his mortgage is fully covered because of the 3 rental income is a lot. So that's a way to do that. It's called a house hacking. You can do some research on that. Um, Primary residency. So you have to move in within 60 days. That is, so if you don't have money on hand, right? How do you qualify for the VA loan? So what I did before was I was trying to move out of Alaska to Colorado, right? So I listed my Alaska property apartment on sale. So from the lender perspective, I want to sell my Alaska property and I want to transition, I want to move to Colorado. So that will be qualify you for the primary residency. Even though we said we cannot use a VA loan for commercial purpose, however, you can rent out your property after you live there for a year. So after you live there for a year, you can rent out your current room and use the VA loan to buy the next one because your next one is gonna be your primary residency. Also, VA loan, there's a VA construction loan. So basically, if you have a land, you can use VA construction loan to build a house. But that's more complicated. You have to find a certified builder, and you have to find a certified approved building plan. And we will not talk about that here, but it's available, VA construction loan. So who is eligible? Just we talk about like you have to finish all the trainings first. and has like active 90 consecutive day in order to qualify. And if you're in the reserve or guard like me, and you are never on active orders, then you have to do 6 years in order to qualify that. A third category. So if we unfortunately died while serving, and our spouse could be qualified for the VA loan as well. Cool. Next, we'll talk about finance. So, quick question for everyone. Would you rather a $1 million now or 1 cent that double every day for a month? That leads us to talk about or discuss how finance can affect us in a good way. So if you choose 1 million, so for those who choose 1 cent that double every day for a month, this is a detailed chart what you will get. So at the beginning we have a rate of return, rate of increase at a 100% because it's like double every day. Then at the beginning, even though we have 1 cent, and after 1 day we have a 2 cent, then 4 cent, continue on. We have by the day 30, we will have a $10 million. Why is that? Because the entire amount is increasing based on the previous day instead of the initial investment or at the beginning. So therefore, we're like it's like a snowball. It's just growing bigger and bigger. And that led us to learn more about finance. So financial compounding, the second bullet over there. So because the earning is not only from your original investment, you also earn from your interest that was generated previously. Therefore, it's like you reinvest your return on a constant increasing rate. Therefore, you're getting more and more. So it's an exponential growth instead of a linear growth. Now, also another interesting term is called time value of money. So in the finance world, if you have some money on hand, you could use it to invest in somewhere else to generate more income, right? So if you don't use that money to invest, it's like a lost opportunity. So that is to say, if you have $1,000 today, and you just hide it under the pillow or put it in the safe box, you're not generating value, or you're not keeping the same value. You're losing the value because you're losing the investment opportunity. Excuse me. So that's time value of money. So time is money in the finance world. So we have an example at the bottom. Same thing. We have $1,000 at a rate of return of 8%. So beginning we have a $1,000, right? So after 1 year, we have a 1080. So the $80 is the interest that is generated from this rate of return at 8%. So the second year we'll have 1166 instead of 1160. Because why? Why is that? It's because it's increasing 8% more based on 1080 instead of $1,000 anymore. See? So the $80 interest that you earned from the first year get reinvested back to your portfolio so it could generate more income. So by the year 5, you will have a 1469 instead of 1400 because the $69 is the interest that you earn from the financial compounding. So if we're using that logic, now let's talk about how to become a millionaire. So if we have a rate of return at 10% and we save 510 or invest 510 every month, right? So after 1 year, we have a 6120, and with the annual rate of return at 10%, we put on another 6120, and this original 6120 accumulate 10% extra interest. The combination will become 12852. If we keep using this method, this compounding method, eventually after 30 years, we will accumulate $1 million, which sounds very easy, right? But before we jump into the next slide, we want to talk something about return, liquidity, and security. So return is usually the most appealing factor. Some commercials saying, oh, you will get a 10%, 20%, or double, but they won't talk about the liquidity. Liquidity is how fast you can withdraw your initial investment. For example, stock market, cryptocurrency, they have a very high liquidity. Basically, you can withdraw your investment anytime you want. It only takes a few days for the transaction. Something with a low liquidity is like a government bond, like a 3-year, 5-year, 10 years, or CD, or sometimes real estate could have a low liquidity because you have to find a buyer in order to finish the transaction, and it takes about 1 to 2 months. However, there's another way to mitigate that. It's called a home equity line of credit or home equity loan, HELOC and HEL. Basically, you withdraw the equity that you built under your house and make a new loan, make that equity as a collateral to get a new loan. So after the liquidity, we talk about the security. Security is like how risky is your investment, how likely you will lose your entire investment. You get nothing back, right? So whenever you think about doing investment, think about security first, and then think about liquidity. Is it fast or is it slow? Like our retirement plan, it's a very low liquidity. After that, two factors, then you are free to think about returns. If those two are not good, don't even think about that. Like continue, even though the return could be very appealing. There's a high chance you will lose. You will not make the money as you expected. All right, so how does that benefit us? Does anyone know something called a TSP? Right? So TSP is a thrift saving plan. It's the retirement plan for government employee or service member. So on the chart to the left, I like the C fund a lot because this one is linked to SP500. SP500 is a Standard Pool 500 company. It's a ETF. It's a mutual fund. So it's a combination of the best top 500 company in the United States. Basically, they're the one who driving the economy of the United States. As you can see, the top 10 here, we have Apple, right? iPhone, Microsoft. It's like the software we are using, Excel, those are all Microsoft. Amazon, everybody buys stuff, right? Online. And Berkshire Hathaway. What is that? So that is the company of a person who is called Warren Buffett. So he is the leader, or he's the top of this company. And then with Google's name is called Alphabet Inc. We search stuff, United Health Group, medical sector, and Google Class C. Yeah, Google has a tooth seat in the top 10. Johnson Johnson, ExxonMobil, JP Morgan Chase banks. So those are just the top 10. So SP500 is the top 500 company in the United States. So it's a combination of all of them. It comes up to this SP500 mutual fund. And because this C fund, C stands for common stock. So C fund is linked to the SP500. So as you can see from the chart on the right, even though when the market crashed about 2 years ago, 3 years ago, 2020, it's negative return, right? Negative 7%. But throughout this entire lifetime average, the rate return of SP 500 or the C fund are both above 10%. What does that tell you? So if you don't know where to invest your money, you can just set up a monthly saving plan to the C fund or SP 500 if you have a good self-control on the stock market. If not, just put in the C fund. All right, so become a millionaire is not that easy because we have annual inflation, right? So you actually need to save $30 for 30 days. So that's like 900 instead of 510. Because the annual inflation is like 2% every year in an average normal year. And then also there's ups and downs in the market, right? Can you really handle when the market is down? And can you hold it when we go through the downtime? Right? Those are all some emotional factor that could affect you on the path of becoming a millionaire. So here today I'm sharing with you is how to build wealth by using the financial compounding power. I'm not teaching you how to win a lottery, right? Even though some people they win the lottery, they get a big chunk of extra money comes in. But if they don't know how to manage it, right, they will spend all the money in a very short time and then become poor again. So this mindset of how to build wealth is very important. Like I mentioned earlier, why I don't invest all my money in the stock market instead of putting in the real estate. Because even though it has a high return, the stock market has a high return, it also has a high risk. The security is not good. So I would rather to choose real estate, which is a low risk with a low liquidity as well. That's just my own perspective, how to build wealth like little by little, steadied constantly. All right, we just talked about how we can become a millionaire by utilizing the power of financial compounding. Then what if we owe money? Do we have to pay extra? Do we have to pay more because of the interest accumulated on the money we owe? So the answer is yes. So if you owe money, you pay the interest on the top of the money you owe. For example, if you have a credit card, you don't pay it off by the end of each month, then yes, the remaining balance accumulate interest. You pay more. Same thing, loan, a car loan or mortgage, home loan, they all have interest you have to pay. So that's how finance could affect us in a negative way. Is when we owe money. So this slide talks about mortgage rate and interest rate. So interest rate is something that Federal Reserve controls. They use that as a tool to either help the market when the economy is bad, or to cool down the market when it's too hot. Like right now, inflation is a big problem. So Federal Reserve increased the interest rate to cool down the market, to cool down the economy. And so the mortgage rate is on the top of interest rate. Usually it's higher because it's adding more loan cost, upfront cost. But however, it's not all the time. Sometimes mortgage rate could be lower than interest rate. Let's use new home construction builder as an example. Each big company, they have a like annual goal they want to reach, right? To make a good year. Sometimes they are all willing to offer a lower rate to attract customers. Like the one I talked to last week. even though the interest rate right now is like 7.5%, but they're willing to offer 5.5% if you close the deal by November. So some lender or some builder, they using this low mortgage rate to attract more customers. So if you saw something like that, you might just take advantage of that because it's like promotion, it benefits you. So next, the higher the interest rate, the higher your monthly payment. So yes, we will cover that in the next slide. And the mortgage payment increase with PMI, private mortgage insurance. We'll talk about that later. So it's basically if you do not use a VA loan, there's a possibility you have to pay an extra monthly fee. It's called a PMI. And the costs differ with the different lenders. So I suggest you to talk to at least 3 lenders so you can shop around, compare which the best rate for you. Whoa, what are those? Why there's so many numbers? Don't be scared, it's pretty simple actually. So we separate those into 3 groups. First 2 row 3, row 4, and the last 3 rows. Now the first row is a scenario that we are talking about if we have the same interest rate, we have the same year, paid off in 30 years, right? So loan amount decide how much interest you pay. So from this scenario, we learned that the lower loan amount, the less interest you pay, right? For the second group, we will be introducing some a term called a seller's concession. It's a way to raise your initial offering price and ask the seller to give the money back at the end so that you can use that extra money to cover your closing cost. So but the money will goes to the loan. So that's the difference. So if you have a 10,000 extra, you put it into the loan, right? Throughout the entire 30 year, the difference could be like a 14,000 because you owe money. You owe more, so you pay more interest as well. So the last group, it tells us this last 2 rows, if everything the same loan amount, same interest rate, if we paid off the mortgage in 15 years instead of 30 years, you save like $500,000 of interest payment throughout this entire 30 year. Even though your monthly payment difference are only $1,000 instead of half. Why? Because remember, interest is accumulating on the remaining amount of the money you owe. So that is to say, with annual rate of return interest rate at 10%, the earlier you make the payment, right, the more equity you build, the less money you owe. Therefore, the remaining amount does not accumulate interest as much as when you do 30 years. So all the 3 categories are telling us that the less money we owe, the better. The lower the interest rate, the better. And the earlier we finish our payment, the better. That's a way to mitigate the interest payment. How do we do that? So that leads us to the next topic, early payment. So those are the first category is like original. If you do 30-year monthly payment, right? You pay this amount of interest in 30 years. However, if you just change your payment method from monthly to biweekly, for example, if you just make $1,000 every month, right? You just cut it in half. Pay 500 in the first 15 days and pay the other 500 in the second 15 days. You actually earned or you actually saved a lot of interest by doing so. Why? Because when you paid off your first 15 days the 500, then you don't, when it comes to the second 15 days or the remaining time, you do not pay the interest for the first 15 days anymore. Therefore, even if you just change it to a more frequent payment with no change of the entire payment amount, you actually saving a lot of money, because in the financial world, time is money. Then the third category here, if we make payment still on a monthly basis, but we just add 100 extra. So yes, you also save a lot of interest by doing so. So if we combine those together, 100 extra per month, and change it to bi-weekly. So bi-weekly plus 100, you will save a lot on the interest payment. And then your loan will be paid off in 18 years. Excuse me. So not bad for an extra $100 per month, right? So same thing. If you have a money you owe, the earlier you paid it off, the better, because it's not accumulating interest anymore. Same thing applies to credit card, car loan, or home mortgage. All right, so we just complete the topic on finance, either how finance could affect us in a good way or a bad way. Next, we'll talk about why we want to use the VA loan, why we want to become a homeowner. So why we want to become a homeowner? Because it could be a good way to hedge the inflation. So for the past three years, the housing price averagely increased about 30%. That's like special time, right? But if we look into long term, for the past 40 years, the housing price increased like over 400%. That's a lot. So buying a house when everything price is increasing, so as your asset, so as your real estate also increase. The second point, it could be a good used as a good investment tool. It's a steady income when you rent out the rooms, like empty rooms, or if you have multiplex, you rent out other units, right? So it's like steady cash flow. It could be a passive income for you. When you have multiple properties, right? You might be able to retire early because you can just collect rent as your monthly income, which can be enough for you to travel or do other things when you don't need to worry about financial income. And fixed payment, that's because when we are buying a house, usually we have a 30-year contract, right? So this entire 30 years, it does not change. The only thing could change will be the property tax or the insurance. That's like a minor compared to others. So you could budget your monthly income versus expense like a more better, because you know how much mortgage you will pay. So if you rent, right, does the rent stay the same when you renew the lease next year, or they increase? Right? Yearly they will increase 5 to 10%. So fixed payment is another advantage when you choose to become a homeowner. Another thing is building equities. So the rent income you pay does not build anything, even though it gives you flexibility. But if you put that into the mortgage, even though for the first few years, usually for 3 years, your mortgage payment goes a lot to the interest. But however, you are still building some equities. Equity is the difference between how much your home worth and how much you mortgage still remaining. So before you paid off your home, it's called equity you are building. Once all the equity, when the mortgage all paid off, and then this equity will converted to asset. So that's different. So when you move to another place, right, you can sell your current house because you have already built a lot of equity on it, so you will get some income from that. Or you can just take the home equity loan, still keep the property under your name by paying a low interest rate if you have that, and to invest the home equity line of credit or the money to somewhere else. Last but not the least, tax advantage. So the mortgage interest payment you pay will help you to offset to benefit you on the tax filing. But I'm not a tax professional, so if you want a specific amount, you have to talk to your tax professional CPA on that. So now we know why we want to become a homeowner. Then next we will talk about why we want to use the VA loan instead of other loan like FHA loan or conventional loan. So the biggest highlight we have on the VA loan is we don't have a down payment. Well, but no down payment doesn't mean you don't need to budget any money because there's a closing cost. There's the earnest money you have to pay when you make the offer. It's a way to telling the seller that, hey, I am being serious. I really want to buy your property. I'm not just saying. And the closing cost could be ranging from 3 to 6% of your total value. So you have to budget that as well. If you have a 400,000 mortgage loan, budget about 12,000 as a closing cost. And as well, inspection is very needed. You want to make sure the property looks good and also actually are good, safe to live. But there's a way if you really don't have a saving to cover the closing cost. There's a term called a seller's concession that we mentioned earlier in the previous slides. So seller's concession is a negotiation tool that we write into the contract. Basically, you can negotiate asking seller, if you are the buyer, right? You ask a seller, hey seller, I am buying your house, right? I'm giving you a lot of money. I'm being broke, like after that, right? If there's something wrong I need to fix, or I need some emergency fund, I need some help on the closing cost, can you help me on that? So seller could either say yes or no, right? If they say yes, then it's great. You get extra money in your bank. If they say no, a mitigation way is to you raise your initial offering price. For example, we increase our offering price from 400,000 to 412,000, and you write into the contract saying, "Hey seller, I'm raising this because I need some help on the closing cost." Then you can tell seller, "Hey, I need you to promise me to pay me back this $12,000 at the end so that I can cover my closing cost." Usually, the seller will be okay because from their perspective, they don't lose anything. They still get the money they listed, right? But that might hurt you a little bit in the long term because you owe more money now. So it will accumulate a little bit more interest on that throughout this entire 30 years. All right, so after that, so another fun feature of the VA funding VA loan is there's no PMI. If you use other loans, for example, FHA, PMI is always required. It's like additional monthly fee you have to pay. But the VA, in the VA loan, acts as an insurance company. They make sure to pay the lender back up to 25% of your loan amount. Therefore, there's no PMI. However, there's a VA funding fee. It will be financed through into the mortgage. It's about 0.5% to 3.6%, depends on the housing value. However, if you have a VA disability rating at 10% above, that means a compensable VA rating, then your VA funding fee will be waived. You don't need to worry about that. Alright, so next topic, we'll talk about when. Do we want to buy or do we want to rent? What is our need? What is our want? Alright, so renting definitely give you flexibility. You're not obligated to this property. You can change it in the next year as if you don't want to renew your lease. Also, on the buying side, you're building equity, the fixed payment. You don't worry about like rent gonna increase the next year, right? So on this chart to the left, we have this table. It's comparing whether buying or rent is better. So as you can tell at the beginning, renting is way better because of buying, when you go through the buying process, there's a lot of closing cost, and also the first few years, since you owe money, you have not built up too much equity yet. A lot of your mortgage payment goes towards your interest payment. So the first few years could be tough. But according to this chart, by the year 9, buying house will actually make more money or save you more money because you already built up enough equity, you're paying less interest throughout the time. However, some people might say, hey, by the year 8, I'm keep renting, and by the year 8, I'll just continue buy a house, right? It's not working like that. When you buy a house, your clock does not continue. It's gonna reset to 0. So you're gonna go through the entire process again. So my suggestion is just my personal point of view. If you're gonna be at a place for over 2 years, right? Think about buying because you're building equity. And even if you leave after 3 or 4 years, you can sell your house. It still could get you some money back. So put your BH into your mortgage payment. It's like saving your BH into the house, building the equity. And this chart tells you how much money gonna cost in the renting. But if you put this money into your mortgage, even though it might not be fully transitioned because part of that goes to the interest payment, right? But still you're building equity. But on the other side, if you have extra room, you can rent it out, right? Those are gonna be the money you generate from that renting income. And when it comes to the house hunting, you know what you need and what you want. Those could be different when it comes to priorities, right? Like how many bedrooms, those are needs. And how long is the commute, those are wants. And how much the price, that could be the need as well. So the lender recommendation, we have a calculation here, is to recommend 3 to 5 times of your annual income. So if you make $130,000 in your household, you can shop around times 5 will be $650,000 housing. So that's like it's relatively safe to shop around that price. Last but not least, emergency fund is very necessary because if something's broken, right, like the heat, the light, electricity, what are you gonna do? You have to use the fund to fix it. And also, if you rent it out to your military friends, what if they gotta deploy? They gotta order, right? Your rental income stopped for a long time. So always budget an emergency fund for a situation like that. Alright, so we just finished the topic of VA loan. Next, we will be talking about the home buying process. COE, or Certificate of Eligibility, is a proof that is generated from this e-benefit website. It tells the lender that you are qualified for the VA loan. Also tells you if your funding fee is exempt or not. And there's something called an entitlement. So because last few years, the housing price is going crazy, right? So the VA removed the cap of the home loan limit if you have a full entitlement. That means you never used your home loan before, VA loan before. So technically, if you have enough income, you have good credit, you can buy a mansion because there's no cap, right? As long as your income debt ratio qualifies it and your lender is willing to give it to you, there's no cap. However, if you have used your VA loan before, like an active VA loan, right? You have a non-full entitlement, then you will have a home loan limit. So in Colorado State, Colorado Springs, we are at El Paso County. The limit for one unit is $726,000. If you have a fourplex, multiplex, it's going to be 1.4 million. So that's the cap if you do not have a full entitlement. So any amount above this cap, this limit, will have a higher interest rate, and then it will become a jumbo mortgage or jumbo loan. So it's a combination of two types of loan. It has a higher interest rate, but still it's a feasible, even though it's exceeding the conforming loan limit. So after you get your COE, you're gonna get something called a pre-approval letter from your lender. All right, in order to find a lender, you can either do your own research or you can use your real estate agent's partnership. Like I mentioned earlier, lender is the one who give you the money to buy a house, right? So they will collect your financial document, basically your W-2, your LES. They will do a background check on you, even the credit score check. They will make sure your income debt ratio is within this range, 30 to 50%, so that you can still make a living, still live when you have a mortgage to pay. Unfortunately, student loan count as a debt, so it will affect you in a negative way. Also, there's a possibility when you have a down payment, for example, this commission loan, if you have over 20% down payment, you don't pay PMI, and sometimes you could have a lower rate than the VA loan rate. So I will suggest you to always talk to 3 lenders, and you can compare 2 rates to say which loan fits you better. And get this thing called a pre-approval letter. It's different from pre-qualify because pre-approval is the official letter that you will guarantee get the loan amount. But a pre-qualify is just an informal letter. It cannot be used when it goes to the loan process. Alright, so after you got your COE, eligible for the VA loan, and you got a pre-approval letter, you know how much loan you can get at maximum. Then time to start the house shopping, house hunting. Alright, next step is to find a real estate agent, also known as a realtor. So they are the trained and certified housing transaction professionals who will keep you out of trouble, make sure everything's legal and accurate. But I also recommend when you look for a realtor, check their testimonial, how other customers review them, and also make sure they have this military relocation professional. They have to take a special training to get that designation to understand how to work with the service member. So your realtor will go through this entire process with you to make sure everything's good. So once you find the realtor that you want to work with, usually you will sign a contract with this realtor to establish this working relationship. And this realtor will set up this MLS, multi-listing service, to collect what's your price range, your budget, how many bedroom you want, how old is the house, which location. It basically is a filter to narrow down your housing hunting search. And then if you find one, you can make an offer now. If it is at the buyer's market, that means it's the buyer's advantage. You can negotiate either to lower down the price with the seller or to ask for more seller's concession because you might be the only buyer that is interested in that property. But on the other side, when we're in the seller's market, sellers are at an advantage. There's a multiple buyer who want to buy the house. So it's like a bidding. They will throw extra cash on it. It was a crazy time about 3 years ago. All right, so once you turn in your offer and your offer getting accepted, now we call it's under contract. Guys, please make sure you do an inspection, right? Just like the photo here. On the left, it looks like a female, but turned out to be a man. Therefore, same thing, same idea applies to the housing. When you do the initial walkthrough, your first impression, it might be fine, everything looks good. But internally, you don't know if the circuit's good, the heating's good, right? All those issues can only be figured out by an inspection professional. So please make sure you do an inspection. And also, there's a title record review. The title company will make sure this property, the deed, is clear to transfer. The property insurance, you will have to get one to make sure the property is covered before the closing. And then HOA, homeowner association, they might have some limitation. For example, they might not allow you to rent short-termly to other tenant. This is an example. So make sure HOA, they have some rules you have to comply with. Survey, make sure your land is in the right area. You are not encroaching other neighbors' land. Loan process, make sure your loan getting approved. And another concern is appraisal of the property. Make sure the appraisal professional will comes in to assess the value of the property. If it is going over of the asking price, that's fine. If it is going under, so the loan lender will only honor the appraisal value. Then if there's a gap, you have to figure out a way to cover that gap. So it's always good if the appraisal value comes in higher than the offering price or the same. And then after that, we do an underwriting review. Everything's approval, then you are clear to close. Congratulations, you're finally here. Do final walkthrough because something could happen on the last week, right? If some window's broken, you can ask either sellers to fix it, or you can ask for more seller's concession to benefit you as a buyer. And everything will be sent out to the title company to make sure the transaction is good and legal and registered. Sign out closing document. Usually the seller gonna sign out the closing document earlier in the morning, and then the buyer will sign everything in the afternoon. Budget some closing costs. Underwriting process will take about 5 to 6 weeks, averagely. The fastest one I saw was like 10 days, but apparently the buyer is buying the house in cash. They don't need to go through the loan process. So there's a term I introduced you, it's called do your own research, DYOR. You know what fits you. You know what's the best for your need. All right, so what we talked about today. And so we go through the VA loan. We talk about what is VA loan? It's a type of a loan that we get the money to buy a house for primary residency only. Who is qualified? You have to be a service member, have a 90 days active service consecutively. That will be like after trainings. Finance basic, time and value of money. We'll talk about financial compounding could either affect you positively or negatively. Why we want to use the VA loan? Because the VA loan does not have a down payment, right? So usually it has a lower rate. Why want to become a homeowner? We can hedge the inflation. We can generate some extra income, fixed payment, and when to buy, when to rent. What's my suggestion? If you're gonna be living someplace over 2 years, think about buying to build up some equities. And then we talk about home buying. COE, Certificate of Eligibility, could be obtained through e-benefit, right? And it's a proof that you're eligible for the VA loan. Also tell you if your VA funding fee is exempt or not. Lender is the one where you get the money from. I recommend to shop at least 3 lenders, right, to compare the rate. And then realtor, real estate agent, which designation I recommended? MRP, yes, military relocation professional. M stands for military. And closing, before closing, do a final walkthrough, make sure everything's still good, in a good shape. And DYOR, represent, do your own research. Alright, so this concludes today's briefing. I want to give a special thanks to Kevin, who helped me to put the slides together. He's also a real estate agent in northern Colorado area. I also want to thank Mark and Louisa, who helped me to make sure some of the loan questions are accurate and precise. Alright, again, my name is Hao Liu. I'm a real estate agent at Colorado. So if you have any question about a VA loan or finance or the home buying process, you're welcome to contact me through this number, my cell phone, or contact me through my email. Thanks for watching. Have a good day. Bye-bye.